Oh,
All righty, well, I'll set this thing to record and we'll get started. Thank you so much for inviting me to speak to Ross University. It's an honor. And I think the focus of this afternoon or evening's talk is going to be primarily on student loans and student loan management and everything that's going on in that arena with the Trump administration, et cetera. I'm sure that's probably the biggest concern you all have. Before I get to that, congratulations on everybody matching. It's an exciting time to be moving on to residency. I recall that well with my wife, who's an anesthesiologist. So I have that kind of background and experience, kind of watching her go through the whole journey from medical school to residency and now into practice, and actually getting close to retirement now. So I've got a lot of experience and perspective. Um, my team is composed of myself, my partner, Greg Hellman, and Tony Montini. Greg and I are primarily the certified financial planners. Tony primarily runs our wealth management and investment specific strategies, but we all work together as a team. Um, and what I want to present to everybody is that everything we're going to talk about tonight, we're willing to meet with any one of you guys individually for one-on-one consultations to help you with your loans, and discuss kind of transition planning and some of the other things we'll get into this evening, which will try to touch on things like disability and life insurance education, general investment education if we have time, and we'll talk a little bit about budgeting and transition to residency and beyond. And what I want to draw to your attention is I don't charge anything to meet with any one of you on an individual basis and help you kind of develop a strategy for your loans, and then provide some advice on some of the other areas. And then typically for those that end up working with us in some capacity, usually it ends up being an insurance policy. But we don't charge anything to help you and continue to help you throughout residency. So take advantage of that. I don't know anybody else that spends the kind of time we do with medical students and residents and doesn't charge them anything on the front end. Um, when we get into financial planning, my partner and I, as I said, are financial planners. And so we do comprehensive financial planning, everything from insurance to retirement, investment planning, education, you name it. We kind of encompass all these different areas. And I do want to draw attention early on that why we'll end up talking a good bit about disability insurance, because it's without income that you really can't do anything else up above on this pyramid. So that really is foundational to make sure we're protecting not only your income and residency, but to make sure we can protect your future attending income in the event of some unexpected injury or illness. Okay. All right. So student loan management, that is the wild card right now, and understandably concern of everybody's. So I'm going to give you the most up-to-date information that we have and give you some ideas. So I think to begin with, it's going to be helpful to have a little bit of understanding of what's going on out there and how things like public service loan forgiveness and these income-driven payment plans have been created. So federal statutory law, those are laws that are created by Congress, um, and then signed into law by the President of the United States. The executive branch, meaning the Trump administration right now, is able to implement and enforce those laws. Regulations are secondary to laws. They're created by agencies that were from the executive branch, but they don't actually have the authority granted to them to contradict the law. And that's kind of what's going on right now. There is a judicial review process where they can review the agency actions to ensure they don't exceed their authority. So basically, if we look back, a congressional statute created what we call the income-based repayment plan. And there's two versions of income-based repayment. There's an original income-based repayment that will be for any borrowers that took out a federal loan prior to July 1st of 2014. Most of you will have taken out loans after July 1st of 2014, which is good because you'd be eligible for what's called the new income-based repayment plan. It has a lower payment amount than the old income-based repayment plan. But both of those repayment plans were created by congressional statute. So public service loan forgiveness was also created by congressional statute. It was created through by the College Cost Reduction Act of 2007, and then signed into law by, at that time, President George Bush. The issue is what was created by regulation were these other income-driven repayment plans. So the pay-as-you-earn plan came out in 2012. That was signed into action by an executive order by President Obama. And then in 2015, REPAY came into existence. And then in 2023, the Biden administration replaced the revised pay-as-you-earn plan with the new SAVE plan. And all that's being challenged now, whether or not the executive branch had the authority to create these new plans, and particularly the SAVE plan, because it increased the amount of forgiveness, I guess, that taxpayers would ultimately be paying. So everything right now is in this litigation. So the Eighth Circuit Court basically put a freeze on everybody that was in the SAVE plan. So we've got folks all over the country that were in the SAVE plan. Now they've been put into a general forbearance with no payments, no interest accruing, but now they're not getting public service loan forgiveness. So that's been a big challenge for everybody. So right now what's going on is Congress is in the middle of this budget reconciliation process. And that's what's going to be really, really important for everybody to pay close attention to, because it's through the budget reconciliation process that Congress could amend or make changes to the public service loan forgiveness and income-driven repayment forgiveness. And all it takes is a 51% simple majority vote to amend or make any changes to those plans. Now, we all think it would be unprecedented to apply any changes to existing borrowers that are enrolled in public service and making income-based payments. However, as we all seem to know, President Trump is doing a lot of unprecedented things, so who knows? So everyone, again, is watching this process very, very, very closely. So there have been some preliminary recommendations from the House Budget Committee. They proposed basically a new repayment plan, or actually scrapping the existing repayment plans with two plans. One would be a 10-year standard repayment plan. That's something that's already in existence. The other would be a single income-driven plan. Now, I'm optimistic because I've created a calculator to model this new plan. Again, it's just been proposed, so we don't know if it's going to come into existence or not. But I'm optimistic because it's being presented by a Republican in Utah. And so with the Trump administration, maybe it stands a better chance of going through and getting approved and passed. So we're going to look at what that plan would look like if that's what comes into an existence, and then compare it to the existing plans that are out there. And I think that'll help a lot. So in a nutshell, what we're going to end up recommending pretty much to all M4s like yourself is that we think it would be really wise to file a 2024 federal tax return before April 15th here coming up, and make sure you save a PDF copy of that. Okay. And then we would recommend that you complete what's called a direct federal consolidation application right after graduation and apply for income-based repayment. We'll talk about the other plans, but it's income-based repayment that again has some statutory protection, and technically it requires approval from Congress to make any changes to that plan. So therefore, we think it's the least likely income-driven plan to be taken away or not count towards public service loan forgiveness. And so what we're trying to do is get folks on IBR, right? And in case they do decide to close new applicants, so that you would be grandfathered into that repayment plan for public service. At the beginning of residency, right, you want to complete then the public service loan forgiveness employment certification form. And that's done on studentaid.gov using what they call the PSLF help tool. That form then establishes your intent that you're intending to pursue public service and that you're working for a qualified public service employer. And as long as you match to a residency program that's run by a nonprofit hospital, then employment during residency would count towards public service loan forgiveness credit. All right. So right now, though, the Department of Education, through an order from President Trump, has directed all of the loan servicers to stop all of the income-driven repayment plan applications, including income-based repayment. There is going to be a court hearing coming up on April 17th, so just a few weeks away, to challenge the reasoning behind not processing income-based repayment applications, because technically, since they fall under congressional statute, the executive branch does not have the authority to stop that processing or amend it. That would have to occur through congressional vote and 51% simple majority to make any changes there. If for some reason the servicers don't resume processing income-based applications, then after filing that tax return for 2024 with no income, presumably, be different if you're married and your spouse has income, you could potentially consider applying for what's called an economic hardship deferment. And that hardship deferment would qualify for public service. Now, that doesn't necessarily solve the problem if they only grandfather in people that are on income-based for public service loan forgiveness. But that might be the best option if they don't resume processing the income-based repayment applications. If you do a direct federal consolidation, which we think makes the most sense right now, basically what's occurring there is we go through and we calculate like a weighted average of all your underlying federal loans. And then we would take that and combine it all into one single direct federal consolidated unsubsidized loan, or a subsidized loan if you have one of those too. And then what they do is they round up whatever your specific weighted interest rate is to the nearest 1/8 of a percentage point. And that's pretty simple. It's going to be different for all of you because you all have different loan balances and interest rates with your loans. So whatever your weighted interest rate is, the most it can round up is a full 1/8 of a percentage point. But if you happen to hit one of these, close to one of these 1/8 of a percentage point bands, then you may hardly have any change at all. You barely round up. Like if you were at 6.621, you'd only round up to 6.625. But if you're at 6.51, then you're going to round all the way up to 6.625. So that round up and the impact of the consolidation on the interest rate is going to be different for everyone. But that's something that we calculate with everybody we meet with, and we quantify that. Everybody is saying now that it's going to be really, really important to capture all of your records, to download your aid data on a regular basis, and to, once you get enrolled in public service, to download any qualifying payments or ineligible payments, or basically keep track of what you think would be qualifying payments if things were counting. I mean, technically, if they process and put you on income-based, then those would be qualifying payments. And so you just want to capture and keep up with those because, as everybody's probably heard, President Trump has essentially fired most of the Department of Education, and most of the people that he let go are the ones that are handling all the programming and administration of their website and all that. So who knows how long the information is going to stay up on their website, and it might get changed. So download records regularly and stay on top of it if there's any chance that you're pursuing or want to pursue public service loan forgiveness. The way you do a direct federal consolidation is you log into studentaid.gov after you've graduated, okay? Because if you try to do a direct federal consolidation while you're in school status, everything will get rejected. So you have to wait until you've graduated. Then you can go in, you click on loan repayment, you click on consolidate loans, and then you click on, it would say, start the process, and you follow the instructions to basically complete the loan consolidation application. And then part of that loan consolidation application is you then move on and actually complete the income driven plan or IDR application at the same time. So then what they do is they process the consolidation, disperse that loan, and then they're supposed to process the income-driven plan application and then schedule to put you on that income-driven plan. And that's what we're hoping to get done potentially before the budget reconciliation process ends or they make any changes to public service loan forgiveness or income base. Because again, what we're hoping is that if they do decide to get away with it, that they would grandfather in everybody that's in it and we'd be able to continue. Also on the studentaid.gov site, you click on public service loan forgiveness, and then I'll bring you up to this public service loan forgiveness PSLF help tool. And this is where you complete the form to then turn in or send electronically, typically to your residency program coordinator. And then that establishes that you're working for a nonprofit hospital. So there's basically with public service, there's two parallel processes that go on. That go on. One is you got to provide income information for them to process and put you on the income-driven payment plan and tell you what your payment is. You then have to do that every year because every year you have to supply new income documentation so they can recalculate what your payment's going to change to. But that doesn't do anything to give you public service credit. That's just the repayment plan. The way you get public service credit is you submit the employment certification form, and there they putting down your start date with your employer, and then the date you signed the form. Then they're going to go back and look at how many of these income-based payments you made between the start date and the date they signed the form, and then they will certify and qualify those payments as having counted for public service. But they don't automatically update those qualifying payments after that. They only update the qualifying payments on subsequent submissions of this form to establish that you're still employed by that nonprofit employer. So best practice is you want to submit this form at the very beginning of employment, and then annually, and then definitely at the end of employment, and then beginning of employment if you do a fellowship or you move on to an attending position with a qualifying hospital. So very important now, I think, to keep up with all that. And every time you submit this, you want to go back and capture the records of all your qualifying payments so that 10 years later, if there's any challenge or records have disappeared, you can put together a good case that you're due for forgiveness. And here's all your records that you made the 120 payments that you needed to be eligible for forgiveness. And then when you log in, once you start making payments, you'll be able to click on your payment history. And that's where you'll see qualifying payments or employment not certified, or right now, the folks that are in the SAVE plan would see not eligible because they're not eligible for public service credit during this court imposed injunction. All right, let's move on and get this control bar out of my way and open up my calculator. Okay, so basically what we do is if you want us to help you with your loans, we'd send you instructions on how to download your loan portfolio in the specific text format we need to import into our Excel calculator. And so here I'm using an example of a current M4 with a loan balance of 266,602. And essentially then what would happen is normally, right, you graduate and go into the 6-month grace period. But if we do the consolidation, then we basically, again, the consolidation process allows us to terminate the grace period early so that you can then apply for one of the income-driven plans and get on it sooner. You can't get on an income-driven plan otherwise until the end of your grace period. So that's a primary reason for wanting to get the consolidation done early so we can terminate the grace period, submit the income-based repayment application, hopefully get on it, and then if they make any changes, we're much more likely to be grandfathered into that program and could stick with it. That makes sense. So the thing to understand about the income-driven repayments, number one, is the payment calculation has absolutely nothing to do with your loan balance or interest rates. It's a calculation that's strictly based on your income and family size. So the way, like in the new income-based and pay-as-you-earn work, is they look up the federal poverty level for your family size. So if you're a single person, they look up the federal poverty level for a single person, multiply that by 150%, and then every dollar you make up to that, you don't have any payment. Once you exceed that threshold, you're going to pay 10% of every dollar you make above that threshold as a loan payment. It's really that simple of a calculation. The SAVE plan had a lower payment calculation than income-based because they raised the exclusion amount on the federal poverty level from 150% to 225%. And so that resulted in more of that income being excluded. But once you exceeded that higher threshold, you're still paying 10% of every dollar you make as a loan payment. To go over how income-based and pay-as-you-earn work. So basically, in the new income-based plan and pay-as-you-earn have exactly the same payment calculation. So that's why if you're a new borrower and all of your loans were taken out after July 1st of 2014, you don't want to get on pay-as-you-earn. There's really no benefit to that. You want to be on income-based because it has that statutory protection from Congress, and the executive branch can't make any changes to that unless Congress amends it by a simple majority vote. So with income-based and pay-as-you-earn, if we take this loan balance and we look at the conventional payments, so conventional payments now are going to be based on your loan balance and your interest rates. So for this particular case, if I scroll down, then with this loan balance of 266 and an interest rate of 7.125, their 10-year standard monthly payment to pay the loans off in 10 years would be this $3,113 a month. And then with a direct federal consolidation loan, you can actually right now take out a loan up to 30 years. Well, that payment for 30 years would be $1,796 a month. And then what I calculate for everybody is what I would call their interest-only payment. And for this case, the interest-only payment's $1,583 a month. So with a conventional loan, in this case, $1,583 is what this person would have to pay every single month during residency just to keep their loans from growing any. Well, what happens with income-based and pay-as-you-earn is anytime this calculated payment based on income and family size is less than your specific interest-only payment calculation, the difference is still the amount of interest that's accruing are growing on your loans every month. Okay. Now that was a huge benefit of the SAVE plan when it came out. And that number one, the payment calculation was lower. And number two, anytime the payment was less than the interest only payment, there was no interest accruing. The government forgave that excess interest. So the beautiful thing there is now all during residency, you were getting public service credit and your loans weren't growing at all, which was extremely important if you ended up not pursuing public service. So that's the challenge now, is if you're not sure about public service, what do you do? Well, it's difficult, not likely you're going to be able to make a conventional payment. It's going to be too high if you have a high loan balance. So that leaves you with either going into forbearance, right, not making any payments, but then your loans are growing, you have that full interest amount accruing every month, and you're not getting any public service credit. So it generally has always made more sense to get on an income-driven plan and make these low payments. So in the event you do public service, you get credit for those years during training. And that limits then when as an attending, you only have to make these, fewer of those higher payments on the back end. Now, I talked about filing taxes and why we think that's a really good idea. And basically the strategy is this: when you go to complete the income-driven application, it's gonna basically say, did you file a federal tax return either of the previous 2 years? And if you say yes, then they're gonna wanna upload your tax return, and they're gonna ask, has your income significantly decreased since you filed your last federal tax return? Well, thankfully, it's not decreasing, it's finally starting to go up, right? So you can answer that question, no. And then they're going to use that tax return, which basically would have zero income, and use that to calculate your payment. And so then effectively what happens is they put you on a $0 payment for the first 12 months of residency. And those payments count towards public service. Okay. Then what happens your PGY2 year is what's going to be your 2025 tax return that you would file next year. It's only going to have half of your PGY1 salary. And so when you submit that tax return, they're going to use it, which is just barely over 150% of the federal poverty level. And it typically creates a very small payment going into your second year. So again, forbearance is a horrible option if you can get on an income-driven payment plan and at least get public service credit for those 2 years. By the third year, your tax returns kind of start to catch up with your annualized salary, because by that third year, it's going to be half of your PGY1, half of your PGY2 that's going to be used to calculate that payment. Now, if for some reason you're in a situation where, say, your parents have already claimed you on their tax return and you're not going to be filing one, then doing the direct consolidation is still a big advantage, because now when you consolidate your loans and terminate the grace period, then we can apply for the income-based plan while you have no income. And so when you answer those questions, did you file a tax return, and you say no, then the next question is, do you have current income? Well, between medical school and residency, you have no income. So you can honestly answer that question no, and then they'll put you on a $0 payment plan. So, but we still think if you can, to file the tax return is better, because that way, if there's any issue and you later have to, for some reason, submit income documentation after residency starts, then you have the fallback of being able to use that tax return rather than supplying a pay stub, which they would use to calculate your income. Let's see. So notice with income-based and pay-as-you-earn that as your attending income escalates, that the payment will rise up and eventually cap out at whatever that 10-year standard payment would have been. So on the SAVE plan and its predecessor revised pay-as-you-earn, notice there's no payment cap. So the payments would keep going up, which means you would have less forgiveness, but it's not so much about the forgiveness, it is about the cumulative payments you make until you reach forgiveness. So last year, in the previous year, for most people, we would have put them on the SAVE plan because we had lower payments, no interest accruing. And then if they were moving forward into public service, we would change plans over to income-based or pay-as-you-earn. And then that would reestablish this upper payment cap. Okay. It looks like they're completely doing away with the SAVE plan. We don't know that for certain yet, but it's certainly looking that way. And what's been proposed is this income-driven repayment assistance plan. And I'm modeling that over here in the blue. Now, this has just been proposed, so we don't know if this is actually going to get implemented, but I thought it would be helpful to see how it works in case it does. And I really like the plan, because basically now what they do is they're going to calculate your payment, the same formula as for income-based and pay-as-you-earn. So you can see the payments are exactly the same. But now what they would do on this new proposal is whatever your payment is, half of it would go to reduce your principal, and the other half would go to interest. And then the excess interest, which would be normally accruing, like on income-based, that is forgiven by the government. So I really like this option because now, regardless of your pursuit of public service, if you're not doing public service, I think it's a better feeling to see that when you do make a payment, it's actually reducing your loan balance and you're not accruing any interest. So whether you do public service or not, I think that puts you in a really good spot. So we don't know yet, it's not mentioned in the proposal, whether or not this repayment assistance plan would count for public service loan forgiveness. That's not being discussed at all. They're just proposing a 10-year standard plan, which would be like this $31.13 a month for 10 years, or you'll have to get on the repayment assistance plan. So that's why we think it's really important to go ahead and consolidate, apply for the new income-based or income-based plan. If you, on the application, it doesn't delineate between old and new. It's just automatically going to put you on the new income-based if you don't have any loans taken out prior to July 1st of 2014. If you do have older loans, then we'll need to talk about what to do there. But I figured for most of you, you're not going to have those older loans. So that's why we think consolidate, apply for income-based, get on it, right? That way, if they do make this change and they grandfather and keep income-based for everybody that's already on it. They did that once already with pay-as-you-earn. For a while there, they closed pay-as-you-earn to new applicants, but they let everybody that was already on it stay on it. So there's definitely a precedence for them potentially putting a freeze and not letting any new people get on a certain repayment plan. So again, that's why consolidate, apply for income-based, and then if they come out with this new plan, and we can always evaluate whether it makes sense to change plans to the new plan. Because even when they froze pay-as-you-earn to new applicants, you could still move out of it onto one of the other plans. So I think that's probably the best strategy to keep all of your best options in front of you and be able to evaluate what's the best move to make as we learn more over time. I don't know if I've looked down here, but basically, you know, what these forgiveness plans look like is if this person owes $266 and they got on one of the income driven plans down here, they'd only pay back like $175 in this case. Whereas if they don't do public service, then typically what you're normally dealing with at the end of residency is whatever that loan balance is grown to, you're basically starting all over and dealing with that. So that's kind of in a nutshell. Does anybody have questions about the loans? And I much prefer audio than a chat because I'm not good at catching those.
I can go first. Do
Okay.
you still file? Do you still file taxes if you didn't work last year?
Yes, you do not have to have worked to file a tax return. Now, often they won't let you. You can just download a 1040 and fill it out basically with no income and put all your information in and send it into the IRS. Now, you need to make a photocopy, right, and save it as a PDF because the IRS doesn't send you a copy of that tax return back. And what we've seen when people do file a tax return with no income, it doesn't always show up in their system. There was a while, let me put it this way, there was a while when we went in to recertify and apply for these plans, they had it set up to automatically link your most recently filed tax return from the IRS site directly into the studentaid.gov system. Well, they've disabled that now. And so, but if it didn't show up, then you'd have to upload a paper copy or a PDF copy. And so if you have saved that PDF copy, then you can have that on file. So when you go to complete the application, you would just indicate, yes, I filed a return, and you'd upload a copy of it, and it would show no income, and they would process that and put you on a $0 payment.
Thank you.
Anybody else? No, okay. Well, take advantage of it. Like I said, I'll send Liz out something she can forward to the student body if they want with instructions, and they can schedule meetings, and you'll have instructions on how to download your loan information and provide the other information we need to import it into this calculator. And then we can meet virtually like this and kind of go over your specific scenario. Let me go over this real quick for those that are married or may have a spouse. So when you get on these income driven plans and you're married, so this would be like a dual, resident, a lot of students are getting married during medical school, right? So if I had two residents going into the same residency program, having the same income, but only one of them had loans, then what would happen is they're now going to calculate your payment based on your combined income and family size. So you can see these payments during residency are higher. So, but if your spouse also has federal loans, then what they have to do is they got to figure out a way to split this payment up between the two of you. And the way they do that is they simply take your proportionate percentage of your combined loan total, and they multiply that percentage by this payment, and you would pay that amount and your spouse would pay the balance. So it's kind of interesting. If I had folks with exactly the same loan balance, right? It's often fairly close, then literally it's like paying your loans off 2-for-1 with public service, because you're paying 50% of the payment and they're paying 50% of the payment. Whereas if they didn't have loans, you'd be paying 100% of the payment. Now, you can file taxes separately and exclude your spouse's income from the payment calculation. Now, that's also something that we don't know about this repayment assistance plan. With income-based and pay-as-you-earn, and with the SAVE plan, you always had the option every year of filing taxes jointly or separately. So if you do have a spouse that has a good job and they don't have loans, then it's often advantageous to file taxes separately, so you could exclude that spouse's income from the payment calculation. So that it definitely gets a little more complicated when you have a spouse with loans and without loans. Just depends on their income, the scenario, where they are in the process along with you. But again, we can model all those scenarios and really quantify what we think, at least at any time of, everything's fluid right now, but point you in the right direction and kind of keep things in front of you. Another question that often comes up with loans is, especially like with income-based, if your payment is lower than the interest-only payment and you've got interest accruing, should you make extra payments to minimize the interest accrual? And generally the answer is no, because you got to realize when interest is accruing, it's just sitting there. Your principal balance doesn't change. And since your principal balance doesn't change, you have the same amount of interest accruing every month. So it's always better to lock in and make that minimum income driven payment. And then if you don't like the idea of accruing interest, you're actually better off opening up a high yield savings account and depositing what you would have been tempted to send into your servicer in the high yield savings account. Now you're earning interest, right? And then at the end of residency, if you don't do public service, then you can liquidate your savings account, send it in, eliminate all the interest that would have accrued, plus you have the interest you gain, so you'd actually end up with a lower loan balance than if you'd made those payments. Now, if you do end up continuing on with public service, then you get to keep the money in your savings account. Having sent it in would have had no impact on your future payments because the income-driven payment calculation has nothing to do with the loan balance. So I think that's an important thing to understand. I've seen that mistake made a lot. People just not understanding and not liking the idea of interest accruing. Hang on to a decision at the end of residency based on whether you're going to do public service or not. Okay. All right. Let's see. It looks like
Sorry, I have a quick question.
Uh-huh.
Because of everything that is happening with the current administration and the dismantling of the Department of Education.
Yep.
So currently I'm a third-year medical student, so I still have the rest of this year, next year to be done and then do the match. But one of my fears is that with everything that is happening, like I'm scared of the possibility that the process of borrowing money from the government is going to be affected in a way that it would make it hard for those of us who don't have like a cosigner or anything, because currently we're not asked for those requirements. So do you think that might be a possibility?
That's a great question. Unfortunately, I have no idea. I've heard that talked about, but that's just not an area that I have any expertise on or wouldn't know how to handle it. But I certainly appreciate that would be a horrible position to be in if all of a sudden you can't raise money for tuition to finish medical school. I don't have an answer for that though.
Hi, I have a question.
Mm-hmm.
For that last scenario that you gave, was that, just to clarify, was that for if you aren't doing the public service loan forgiveness?
I mean, the example that if you wanted to make extra interest payments not to do that?
Yeah, with putting it in that savings, high yield savings account.
Yeah, so that really can be a strategy whether you think you're doing public service or not. I mean, the reality is you get a lot of people that they think they're going to do public service, but then they don't. People that don't think they're going to do public service, and then they do. So
okay.
Go ahead.
Yeah, with the if like people wouldn't do the, because there's like a hospital system out there called HCA, and that's the largest healthcare. It might even be the system in the world, and they're a for-profit. But I know that they have the largest amount of like residency sponsorships or spots or whatever. And so, how would a scenario work if like that's where you're doing your residency at, and it's a for-profit institution? Could you give like a brief little scenario of that? Thank you very much, by the way.
Oh, you're welcome. Unfortunately, if you match to a for-profit program, then you can't get public service credit. You can still be on an income-driven payment plan, right? So then the question becomes, like, at the end of your residency, it all depends on what's your loan balance, what specialty you're in, so what's your income potential, and what do those future potential income-driven payments look like. So if I come in here and my calculator, and let's drop this, you do this and just drop the income assumption so you can kind of see what that could look like. So you see here, if I drop the income relative to your loan balance, right? Now these payments, these income-driven payments, start to drop down well below that 10-year standard. So it really depends on your loan balance relative to your income potential, what these income-driven payments are going to look like compared to the conventional payments. So in this scenario, if you say we're doing a 3 or 4 year residency with an HCA hospital, and now you are on income-based, and you get out, and you've got this $335,000 loan balance that's grown, well, then I could actually carry this out to, say, the 13th or 14th year, where you would continue making payments. Now you just wouldn't get credit for these first 3 years or 4 years, right? So it'd be like starting here and continuing. So then we got to compare that to the conventional payments. Well, if your conventional payment for 10 years to pay the loans off conventionally is $31.13 a month, but by continuing on in public service, you can make these lower payments for 10 years, then public service is still a good deal. So we always keep it in front. We always have to evaluate. It just depends on your income relative to your loan balance, how long your residency is, and then looking at how things look coming out of residency and moving on. So during residency, though, that would certainly be a scenario. It's never a bad idea, if you've got surplus in the budget, to budget like you're making higher payments. You just wouldn't actually send that excess money into your servicer, because it wouldn't help you any, because since interest isn't capitalizing every year, it just sits there in this accrued bucket. You're better off putting that excess money in your own account. And then at the end of residency, if you don't end up doing public service, then you can liquidate that account, send it in, and you'll end up with a lower loan balance than if you'd made those payments all along. But if for some reason it does make more sense to continue in public service, and you did make those extra payments to your servicer, they wouldn't help you. They wouldn't change the future income-driven payments you need to make until you get to forgiveness. So hang on to your money. Don't panic because you're accruing interest. That's normal. In fact, I've been helping folks with loans since probably 2012, when they came out with Pay As You Earn. And prior to this last few years with the Save Plan and Repay, there's always been interest accruing. And that's just something we've had to deal with. So hopefully that helps.
Yes, thank you very much. I appreciate that.
You're welcome. Thank you. All right. Any other questions on the loans to clarify anything before I move on? All righty. So I don't know what your exposure's been yet at Ross, but one of the things that we definitely want to have an understanding of is disability insurance. And before I get there, let me kind of clarify, I think, how folks are paid in the financial services industry. So I look out there and I think that it looks like a lot of revenue is being generated from insurance commissions and investment management fees or commissions. So things like helping you with the loans and budgeting and a lot of the planning, that doesn't generate any revenue unless somebody charges a fee. So the reason I don't charge any fees to help people with planning and the budgeting and stuff in transition into residency and then out of residency and into your attending practice is if it makes sense to get something like a disability or even a life insurance policy in place, whenever you do that, the insurance company is going to pay whoever sells it to you a commission. And there's no way to bypass that process. And typically the commission on something like a disability policy is usually about 50% of whatever the first year's annual premium is on that policy. So if you were paying $50 a month, $600 a year for a disability policy, whoever sells it to you is going to make about $300. Now, I look at what people are charging out there for student loan advice, and it's usually more than $300. And then they want to keep charging you that. So in the long run, I will make more revenue if I help you out with the insurance and I can earn your trust to have that business. And so because of that, I'm willing to help folks with the loans and the planning and all that. Now, once you become an attending and your income goes way up, now there's a lot more planning to take place. And we usually transition to some type of a fee-based arrangement to cover the excess time. But during residency, I would rather you protect your future income with a disability policy than have you spend money on loan analysis and not protect your future income. So we'll dive into that a little bit. Disability insurance, right? So a very, very common perception with young residents is that when you look at your residency program benefits, they're providing disability coverage at no cost. And let's face it, I mean, I would totally agree that the risk of getting disabled during residency is super low. And then I would intuitively think that, you know, why do I need to consider coverage if the residency program is buying it? And then I would normally think, wouldn't it make more sense to wait till the end of residency and evaluate what my attending benefits are before looking at individual coverage? Plus, usually when I hear people talk about it, it seems pretty expensive for the risk being so low of getting disabled during residency. And I agree with all that. Before we get further, though, I need to give you a little bit of a background and understanding of some of the differences between employer-provided coverage and individual coverage. So with employer-provided coverage, we usually have folks go out and get what's called a certificate of coverage so we can look at the contractual terms and definitions. And sometimes with hospital coverage, we see what's called an any occupation definition. Not very often, but to give you an example of what that's like, let's say I'll use a surgeon as an example. Let's say you're a surgeon and you crush your hand and you can't do surgery anymore. You're going to file a claim with the insurance company that has that disability. They're going to come in and investigate the claim. And they would probably agree that you can't practice as a surgeon anymore because of what happened to your hand. But if the insurance company still thinks you're capable of doing anything else in the national economy, they don't have to pay. In essence, you would then have to be unable to do any occupation before they're going to pay a benefit. Now, what's much better to have is what's called an own occupation definition. Now, what they would do is typically look at the material and substantial duties you're doing at the time of claim. And if you can't do those duties, you're totally disabled, they're going to pay you the benefit. Some of those contracts, though, if you're able to work in a different occupation or specialty, as you start earning income, they're going to start reducing the benefit. Others, if you're able to work in another occupation, they'll keep paying you the full benefit, regardless of income you could make in a different occupation. Now, what's kind of problematic is I still see a fair number of hospitals out there, when I look at their contract, where it starts out as an own occupation definition, but it's only good for 24 months, and then it turns into an any occupation definition. So if you crush your hand, they're going to pay you for 2 years, and then they're going to come in and say, we think you can do something else, we don't have to pay anymore. Now, sadly, most people don't discover those nuances until something happens to them, and then it's way too late to do anything about it. Now, overarching all of that, people don't readily seem to understand that all employer-provided coverage falls under a federal law called ERISA, which stands for the Employer Retirement Income Security Act of 1974. And it turns out to be a very pro-insurance company federal law, because under it, the benefit of the doubt goes to the insurance company, and you can't have a jury trial. So if you file a claim and the insurance company doesn't pay the way you expect them to, you would probably end up hiring a law firm to represent you and fight the insurance company. The attorney you hire is going to have to present information to a judge, since you can't have a jury, and the judge is going to have to make a decision from the legal perspective that the benefit of the doubt goes to the insurance company. And the real kicker is, if you win the case, the insurance company is not liable for any more than what they just should have paid you to begin with. So it should be no surprise you see a lot of lawsuits with employer-provided coverage. In contrast to that, right now across the country, I see most physicians will end up having their individual disability policy with one of these 5 companies up top. They're the ones that are selling the individual specialty-specific contracts, where if you can't practice in your specialty or subspecialty, they're going to pay you the full benefit regardless of your ability to earn income in a different specialty or occupation. Now, there's some differences between these contracts, but really the differences between them are relatively small in comparison to the difference between any of them and the employer-provided contracts. Primarily is the individual contracts that we would consider, they don't fall under that federal law ERISA. And the significance of that is now the benefit of the doubt goes to you, the insured, and you could have a jury trial. And everybody knows juries don't like insurance companies. So by comparison, you don't see very many lawsuits with these individual specialty-specific carriers. Okay? Now, let's look at a specific example. If your residency salary is $60,000 a year, and then we look at your program benefits and we determine that they provide 60% of your pay, which 60% of 60,000 would be 36,000 or 3,000 a month of gross income. But anytime your employer provides disability insurance at no cost to you, if you get disabled and start collecting that benefit, it's actually taxable income. So if I calculate the tax withholdings on 3,000 a month of income, it drops your take-home pay here from $36.93 to about $23.30 during a disability. So you have about a $1,400 pay cut. Now, all these companies that sell these individual policies, the ones we would look at, will let a resident get as much as $5,000 of monthly tax-free benefit during a disability. And if you have an individual policy and your employer provides group coverage at no cost, should you get disabled, you would actually collect both benefits. So the individual would be tax-free income, and the after-tax amount on the group policy, you'd have a combined income take-home pay of about $73.30. So you're essentially making twice as much during a disability compared to what you were making as a resident, but you're still going to make a lot less than you would as an attending. So the insurance companies are willing to basically over-insure you because they know you still have a lot of financial incentive to get well and go on to practice, okay? Now, I still circle back to a lot of thinking where what's the probability of getting disabled during residency? I think it's really, really low. And I totally agree. But I'm trying to teach people that that's not where I see the risk. The risk is not understanding what you have to go through to get an individual policy in place. And so people see people getting stuck with what are called medical exclusions, or even getting declined, and now they can't get an individual policy. So people don't tend to realize when you go to apply for these things, you typically have to go through a financial underwriting process and a medical underwriting process. Now, during residency, they waive the financial underwriting. Basically, the whole objective of financial underwriting as an attending is they don't want you to be able to make more disabled than practicing. Otherwise, you wouldn't have any incentive to go back and work. So they limit how much coverage you can get. And that's true of all insurance. I mean, you can't insure a $20,000 car for $100,000 because the insurance companies know you would have an accident and want to collect that claim. It's the medical underwriting that shocks people. When you go to apply for these things, they're going to want to they're going to want to have you answer medical history questions going back like 10 years. They're going to want to get access to all of your medical records and review attending physician statements. They're going to run a pharmacy scan, and they'll get a list of all the medications you've been prescribed and who prescribed them. And they'll often send a nurse out to get a blood and urine sample and run a full metabolic profile. And what they're doing is they're combing through all of that information, looking for anything in your medical history that they think puts you at a higher risk of filing a claim at any point in the future. And if they find something, what we see is they'll put what's called a medical exclusion rider on your contract. Now, these are just some snippets of residents over the years that applied during residency and had some type of medical exclusion come back. The first one was for heartburn. So if this guy ever has an ulcer and it creates a disability scenario, it's not covered. This middle one was an anesthesia resident down in Louisiana I was working with. And the story she told me, she took her kids to an ice skating rink for a birthday party. And she said her little one is having trouble on the ice. So she walks out to help him off, and some teenager lost control, wipes out into her. She falls, distal radial fracture of her right wrist. About a year and a half then goes by. The wrist is healed. She thinks she's fine, no issues. She goes to apply for disability, and the best offer she was able to get had a permanent exclusion on the wrist. So now if she can't intubate or do a regional blocker procedure or even mask a patient because of a complication with the wrist, it's not going to be covered. I remember I had an orthopedic resident broke his little finger playing basketball during his residency, was going on to do a hand fellowship, applies to get disability insurance. The insurance company gets those records. They put an exclusion on his hand. You don't want an exclusion on your hand if you're a surgeon. We see a lot of back issues. One of the craziest ones, I had a resident said she was just sitting on the couch one night watching TV. She sneezed and herniated a disc. She gets an MRI, there's a bulge, they give her a steroid injection. By the time I met with her, she didn't think anything was wrong with her. She applies for disability before going to do a fellowship. The insurance company gets the records. They declined her. She couldn't believe it. We went to 4 other companies, the same result. They all came back and said, look, we'll look at her again in 3 years. And if she's had no problems with her back and it's well documented in her medical records, best case scenario, she'll get coverage, but there's going to be a permanent exclusion on her lower back because they're concerned about that disc when she gets older. Females have higher morbidity statistics, apparently. So females pay more for disability insurance than a male. We, on the other hand, have higher mortality, so males pay more for life insurance than females. But I do see a lot of female stuff, see a lot of PCOS out there, infertility stuff sometimes, you name it. The biggest one we see is, somebody taking something for anxiety, depression, or ADHD. And if you do, then every single company is automatically going to put a mental, nervous, and substance abuse disorder exclusion on an individual disability policy. I mean, frankly, I don't know how you get through medical school and residency without some anxiety and depression, et cetera. But that's the way the industry is right now. They'll exclude it. The only way you can get the exclusion removed typically is to be treatment and medication free, usually for at least 3 years. And then they'll let you apply sometimes to remove that exclusion. But that's about the only way to do that. You see things like, psoriasis, creating a psoriatic arthritis exclusion. That makes sense to me. You know, ADHD meds going to result in mental, nervous, and substance abuse disorder exclusion. But look at stuff like this, bunions on both feet. Now, this person has a permanent exclusion for any disease, disorder, or impairment of the feet, including treatment or complications thereof. Here's an anesthesiologist that had a torn labrum. Now they have a right shoulder exclusion. You don't want that. Hard to intubate if you've got a bad shoulder. Here's somebody with an esophagus exclusion due to recurrent EOE. And look at this one, a ganglion cyst in the right hand. Permanent exclusion now for cyst, tumor, or neoplasm, or any disease, disorder, or impairment of the right wrist, including treatment or complications thereof. So I think you start to get the idea that none of these people thought there was anything wrong with them, certainly not related to a disability. I mean, look at this one, tendonitis, you know, both hands, wrists, just full of exclusions. You certainly don't want that if you're a specialist with your hands. You know, skin, sleep, insomnia exclusions, you see all kinds of stuff. So what I've been trying to teach people is that every one of these individual companies that sell these individual specialty specific policies, if you can get through their medical underwriting process, and ideally there's nothing wrong with you, every single one of them will let us put a rider on that contract that now guarantees you can increase your coverage in the future up until the age of 55 without ever having to answer another medical question. So if there's no exclusions on the initial contract, you don't ever have to worry about exclusions, even if something does happen. You can protect that future attending income. If you're in a situation where they do put some type of exclusion, like I said, the most common would be like mental nervous, then there would just be a mental nervous exclusion on all the future increases unless we're successful getting that removed. So I think that the whole motivation should be for getting disability. It's not about the risk of getting disabled, because that's super rare. Yeah, it can happen, but it's very rare. I think it should be more of a prophylactic recommendation to get coverage in place as early as you can to protect against getting one of these exclusions, because that's where we see the complications arise. And, you know, if like I said before, I think I rarely have a resident spending more than $100 on any type of insurance. Usually the average on disability is like 50 to 75 a month. But let's say it's 100. If I took $100 a month instead, $1,200 a year, and invested it and got an 8% return rate during a 4-year residency, it would only grow to $5,800. And then if I let that ride until retirement 35 years later, it only grows to $63,000. And that is a minuscule number in comparison to your income potential as an attendant. I mean, I would expect all of you to make anywhere from 12 million on the lowest end up to 24, 36, 48 million or more during your attending career. That's an astronomical number that's at risk if you can't protect that income. And that's what I see happen. I see every year people across the country, they've got some type of exclusion. You can't get it removed. Now, you can fall back if you work for a hospital. They're going to provide some level of coverage usually. But what I see with hospital systems is they're usually providing disability, 60% of your income, up to some monthly cap. That monthly cap can range anywhere from $5,000 a month to $25,000 a month. So if you're making $400,000 and the cap's $5,000 a month, that's not protecting much income. You've got to be able to supplement that with individual coverage. And even if it's at the $25,000 level, because that's taxable income, you still end up having to supplement with individual coverage to make up for the tax loss and get anywhere close to replacing most of your attending income if something unexpectedly happens. So that's the whole process. Now, I could send this to Liz and she can email it out to the whole class, but I've got a website set up where you can click on this link and you can run your own quotes, and it'll show you what you're likely to pay. I have it set up to kind of run it with the minimum amount of coverage. And that's kind of what I'm getting into next, is when I looked at these companies, I was trying to figure out not what's the most coverage you can get, but what's the least amount of coverage you can get to supplement what your program provides at no cost. Because remember, you get both benefits if something happens to you during residency, but for the primary reason of now being able to prophylactically protect future access. And so what we learned is that some of the contracts out there only offer what's called this future increase option rider. Now, that's a rider you pay for. So this is the monthly premium to be able to carry the ability to access an additional 15,000 of coverage in the future if you ever qualify to get that much more. So with that type of rider, it's a multiple of the base benefit. So you pretty much have to get 5,000 of coverage to secure access to another 15, but that really drives the cost up. So that other rider, this benefit purchase rider that doesn't cost anything, it's not a multiple of the base benefit you get, it's just a threshold requirement. And so what I illustrated here with companies C through F is what's the least amount of coverage that we can get. Well, they'll put that rider we want on the contract. And so with this middle company C, they say you have to apply for at least half of what you're eligible for. So that's 2,500, and they'll put that rider on the policy. And that literally protects your ability to get as high as 30,000 a month of benefit if you ever make enough income to get that high. Companies D and E here, they say you have to get 75% of what you're eligible for. You could apply as a fourth-year medical student and get a little bit less. Company F says you got to apply for at least $1,000, and they'll put that rider on the policy. So you can see it doesn't have to be tremendously expensive. Now, the companies you'll see here, I've got where they have like two different premiums. That means it's the difference between what's called a graded premium and a level. So graded level, level only, graded level, level only. Now, the difference between those is for the benefit amount. Let's say we're looking at this 2,500. You could do a level premium that's never going to change. Or you could do the graded premium that's going to start low, but it's going to increase every year. Now, if you stayed on the graded premium for your entire career, you'd spend a lot more on the coverage. But all the companies that offer a graded premium will let you convert from graded to level on any policy anniversary date. But every year you wait to do that, the new level premium is going to be just a little bit higher. But it's typically always lower, the graded premium, than this original one is. So we typically have residents do the graded for the primary reason to prophylactically protect access and minimize costs during residency when the budget's tight. And then when you start your attending position, you just convert that graded premium to level. You then lock in a new level premium that will be substantially less expensive than if you stayed on the graded. And then as an attending, when you go to increase your coverage, then we would typically take that out as level premium. So what I did here in the blue is I just tried to run an apples to apples cost comparison on the same benefit amount, same issue age, same sex, same benefit period, same cost of living adjustments, just to be able to see a cost, apples to apples cost comparison. So if you go around asking people what they're paying for something like disability, number one, you got to know what the benefit amount is. You got to know the issue age they took it out, because that impacts it. You got to know whether it was a graded premium or a level premium. They need to be the same specialty and the same sex. And then you can compare them. So you can't compare graded to level, level to graded, or male to female, or surgical to primary care. They're going to be different. In fact, here you can see this is male surgical kind of rates. And where you'll really see the difference is up top in the blue. But if I go to female, Remember I said females pay more, premiums are higher. I go to primary care and males, the premiums drop. I go to primary care female, premiums go back up. You go to something like pediatrics, premiums go down, right? But female, they're going to go back up some. Okay. So basically, from a financial planning perspective, everything we do, most of what we do just requires income to work with. But every year, I swear, it's the insurance stuff that haunts people, because that's the only stuff you have to go in and give medical, qualify medically to get. And the interesting thing too about insurance is you can only get it when you absolutely don't need it. The second you think you might need it, you can't get it anymore. So you can only get it when you don't need it. And then, the reality is, as you guys will appreciate being in medicine now, is when things happen, they're always unexpected. And then it's too late. So I deal with that every year with folks where, they put it off. Now they can't get disability. What do I do? There's really no options. We can't undo the injury. So you really got to get these things in place early. And I'm just trying to teach people it doesn't have to be an expensive proposition. Now, what we typically do is recommend as a student, now that you've matched, the process we carry people through, close this now. The process we carry people through is you can apply now that we've matched and we know what your specialty is. It doesn't cost anything to apply. It doesn't even commit you to anything. I don't want anybody to jump into something you're not totally understand how it works and why it's the benefit to them. What we want is, we don't want you to have to start paying for something until you start getting paychecks and residency and you kind of confirm your budget and cash flow. So, but you apply, you hopefully get approved, then we're able to sit on those offers for up to 6 months. Then once residency started, you've kind of confirmed everything and it still makes sense, then we can have them issued and you start making those payments. If you change your mind for any reason, there's no fine, there's no penalty, there's no credit reporting. You just won't have the coverage. You'll have to go through medical underwriting again at some point. So there's really no risk to any of that, but we sure think it makes more sense to get things started, because even with the best of intentions, we've observed when residency starts, it's like being thrown into an alligator pit and you're just trying to survive. You come up for a breath of air, the last thing people seem to want to do is talk about insurance and all that stuff. You're just too overwhelmed and busy with everything going on. One last place I should take you to for some perspective, and it's a website called diattorney.com. And I tell people it's the closest thing that I've been able to find to like a peer-reviewed independent journal source for disability insurance. And all it is, it's a national law firm, and all they do are handle disability lawsuits. And so on their website, they've got a link to your disability company, and they're doing a review of their experience getting all these companies to pay disability claims. Now, I feel like the information on this site, right, it's not coming from a salesperson. It's not coming from a marketing person at an insurance company. It's coming from the attorneys that are suing the insurance companies to get them to pay the claims on their contracts. Now, most all of these companies don't sell the individual policies. They only sell the employer-provided contracts. Now, I mentioned my wife's an anesthesiologist. In her hospital, they use Hartford for their group disability. And I see a lot of hospitals use Hartford. But look what these attorneys say about them. Hartford is a multi-billion, two-headed monster that'll hide behind the wall of those ERISA disability laws in an effort to unfairly deny long-term disability claims. And no matter what any TV station, newspaper reporter, or court says, they continue to handle claims according to their own rules. The more than 40 companies that sell long-term disability, it's our opinion Hartford is one of the most difficult companies to deal with. And you do see that resonate with a lot of companies. Cigna is another company I see a lot of hospitals use. And here they say on a daily basis, attorneys speak with individuals who have been denied benefits or concerned they're going to be denied. Numerous federal ERISA lawsuits filed on a weekly basis due to unreasonable claim denials. You see that over and over with ERISA because all the employer provided contracts, remember, the benefit of the doubt goes to the insurance company, puts the burden on you to fight them. And if you win the case, they just have to pay what they should have paid. So you see a ton of claims. Now, the individual carriers typically are going to be like Emeritus. I don't see any negativity here. They don't have anything bad to say, which is a really good sign. They don't also necessarily have anything real positive to say. But the fact they don't have anything bad to say is a real positive. Can look at like Mass Mutual, another really good company, been around a long time. Again, they don't have much bad to say. You'll see like they're not governed by ERISA. That's going to be true of all these individual contracts that we would look at. But the fact they don't have anything really bad to say is a really good sign. Principal's another one. A lot of filler information, history of the company, other stuff they do like 401k plans. They don't have anything really, really bad to say. The only one that seems to have some negative stuff that sells individual policies, and I do see residency programs that have coverage with Standard, but basically you scroll down, they say the disability division of Standards run under a very tight leash with strict guidelines. Hundreds of lawsuits failed against Standard, failure to pay benefits. They scrutinize and review all their claims closely, and this bothers me the most, that some of their examiners are attorneys. That just screams they're looking for contractual reasons not to pay the claim. So where I feel comfortable taking people is Guardian is the parent company. Now, Guardian does have group policies that fall under ERISA, but all of Guardian's individual contracts are actually issued by their wholly owned subsidiary, Berkshire Life Insurance Company. So usually when you hear people talk about Guardian, they actually Berkshire. And if I click on what these attorneys say about Berkshire, a little bit different tone, because here they say, in our opinion, Berkshire is one of the most highly respected and trustworthy disability insurance companies. The majority of their claim clients are business professionals, doctors, dentists, and lawyers. I think Guardian probably has one of the highest market shares for physicians. They say Berkshire is one of the few long-term disability companies that actually wants to make the right decision on the claim. They don't always get it right, but they'll give more effort and attention to your claim than any other disability company. Pros, Berkshire will give a claimant the benefit of the doubt when evaluating a claim, where most companies will seize any opportunity to deny a claim. But Berkshire doesn't behave that way. They'll be very detailed in their request for information, but they'll give a claimant every opportunity to support their claim for disability. The only cons, they're going to ask for a lot of details and information, but all companies are going to do that. It's not fun to go through a disability claim. From our kind of clinical equivalent perspective, the claims we have with Berkshire, it just feels like they're looking for reasons to pay legitimate claims, as opposed to looking for reasons not to pay. But again, all these individual contracts are vastly better than the group contracts because they don't fall under ERISA. And because the benefit of the doubt goes to the insured, you're much less likely to see a lawsuit. But so that's where in my spreadsheet that I had in this thing, right, all these, company C was Berkshire. So I feel very confident that, you know, that's probably the best place to start, because you can get the least amount of coverage, low premium, and prophylactically protect future access. To get bogged down in any of the differences in these contracts is going, and to choose a different one is going to end up requiring you to pay more to get the coverage. And that's why kind of doing the research and looking at what the DI attorney site says, I feel like there's not a better option than Berkshire, and especially if you're a surgeon, because Guardian's definition for surgeons states that if you're a surgeon and more than 50% of your income comes from doing surgery, and you can't do surgery anymore, they will classify you now as totally disabled. You will collect then the full benefit, even if you're still able to work in your same specialty doing clinic or non-surgical duties. It's the only contract where that's possible. Every other contract would consider that a partial claim, but I really like the idea of if you crush a hand or something, but you can still do clinic and work in your same field of expertise, then that's a big benefit because you can earn income without them reducing the disability benefit. So that's generally where I steer people. I like doing the graded premium because at the end of residency, I have no idea if one of these other companies is going to come out with a better contract. So we usually review everything coming out of training. And if there is a better option and nothing's changed with your health, then we can always apply with the other company. And if you get approved with no issues, you can then drop the one you have. There's no penalty to do that. But if there is something that turns up or happens that would result in an exclusion or being declined, well, that's why we're doing it to begin with, because you have a mechanism now to be able to increase coverage and protect that future attending income without worrying about having any medical exclusions. So I hope that's not like too much information, but I think it's really important to hear and to understand and to realize it doesn't have to be expensive, but the impact it has from a long-term financial planning perspective, there's just nothing else that I can think of that has that big of an impact if you suddenly can't protect that attending income or you can't get the coverage to protect it. So it's really important to try to get that in place as early as you can. And of course, again, as I mentioned, we can help you with that. We pretty much have access to all the carriers. So we can run numbers, give you a quote. Then we'd recommend you get into the underwriting process, hopefully get a clean offer, and then we can sit on it for up to 6 months and kind of get settled in residency, confirm your cash flow. If it makes sense, then we can tell them to have it issued. Then you start paying for it and you're covered. And of course, in exchange for that, you're going to be our client and we're going to continue to help you to support the loans and stay on top of that. We typically end up meeting with folks once or twice a year, it seems like, for student loan management. Every year, that seems to be the most important thing to people, to kind of make sure that's being updated and they're staying on top of that. So unfortunately, I intended to get into some budgeting and even some basic, investment education, but looks like we're kind of running out of time. But again, that's something I would provide to everybody on an individual basis. You got downtime between now. I know you guys are busy kind of getting settled, figuring out places to live for residency, but we are available. And I'll have Liz send out information to the class, instructions on how to get in touch with us if you want. And again, there's no commitment. I like helping folks. Medicine's been really good to my family, and I enjoy giving back and helping young physicians learn about these things. Because I do tell people my experience, I think half of my experience was coming from being on the receiving side. So I don't think I mentioned this at the beginning, but I got a BS in chemistry. And so my first job coming out of school was selling specialty process chemicals. I did that for about 13 years. So during that time, my wife was finishing her training. And when she's coming out of training, we're meeting with different financial advisors. And so I have that experience of having been on the receiving side. And I found it very frustrating because I felt like people were just trying to sell me stuff. And I wanted education. I mean, I'm very analytical, so I wanted to learn how things work and what to do. And I just felt like they were in and out trying to push me into something without really answering all my questions. So that's when I established this practice, and I only work with physicians because I feel like I can communicate well from a scientific standpoint with doctors. And and helping you understand how these different products work, how investments work, and kind of piece it all together and help people develop a plan. So that's what I do, enjoy doing it, and hope we get the chance to work together. I did record this, so Liz will be able to send out a link to the recording. And feel free to tell your classmates about us, and we'll help as many people as we can get to. Any last questions?
Thank you so
Thank
much.
you.
All right, thank you all. Again, congratulations, and look forward to hearing from some of you.
Yes, and I'll definitely send this out to the group. So please see the different group chats, and I'll post the link for everyone to be able to review this on their own time as well. So thank you all again. And thank you, Mr. Long. We really appreciate you joining us tonight. And I will see you actually at the end of the month. So
All right, my pleasure, Liz. Thank you, everyone. And again, congratulations, and best luck getting moved to wherever you're going.
Thank you.